Well, it was a bit of a quieter week for markets last week as summer vibes appeared to set in, but there was still plenty of interest out there for traders nonetheless, with US inflation coming in and ticking a little bit higher on a year-on-year basis, nat gas spiking amid some supply concerns, and continued worries around the state of the Chinese economy all in the mix as well. Putting all of that together, although it was a little bit of a quiet week, we did see equities tick a little bit lower, yields rising at the front end of the Treasury curve, and the dollar remaining the pick of the bunch in G10 FX. Another relatively quiet data calendar awaits this week. We've got US retail sales due, but we've got a busy week back in the UK as well, with the latest jobs and inflation figures on the slate, both of which will be key in determining the next move from the Bank of England. Another busy episode of The Trade-Off awaits, so let's get into the show. So, plenty for us to discuss this week. My surroundings are, again, different, coming to you from Portland, Maine this week as I continue to take my summer break. Ryan Littlestone is joining me, as always, from Forex Flow Live and Forex Analytics down on the south coast of England. Ryan, I assume you're enjoying, 27-degree heat and sunny days on the coast, just as I am here, mate?
Oh, yeah, thanks, mate. Thanks for picking that one up. Yeah, it's been great weather for ducks. Yeah. I'm just waiting to see. We might see the sun again sometime this year. You never know.
Well, as long as the sun makes an appearance by the weekend upon my return, then, as they say, the sun shines on the righteous. So, the chances are looking good for that, I guess.
It might shine out of something, but it's not the sky for the moment.
Well, before we go down that route that we probably shouldn't go down, let's get on to Topical Thunder. So I want to kick things off this morning after some last-minute revision last night around what actually happened in the markets last week with the latest US inflation data. It was last week's main event and perhaps only real event in terms of economic data, at least. And it showed that disinflation was continuing at a core level, at least, with core coming down to 4.7% on a yearly basis in July, down from the 4.8% that we saw in the prior month. But I think if you dig into the report, this just speaks to something that I know we've discussed on many occasions in terms of inflation, in that the last mile of inflation, in terms of bringing inflation back to that 2% target, is going to be the hardest for the Fed and for other policymakers worldwide. Headline inflation did tick slightly higher to 3.2% in July from the 3% that we saw in June. So that snaps a year-long run of lower headline year-on-year prints, although disinflation is still ongoing. And I think this speaks to something again that we've spoken about before in terms of the base effects that have been helping to drag headline inflation lower. They're not going to really be helping. They pretty much net off to having no effect at all in the second half of the year. And I think this is important to bear in mind because it's only going to take headline rates of 0.3, 0.4% on a monthly basis to bring headline CPI back towards the 4% mark on a yearly basis by the end of the year. And I think the market and the conversation around the policy outlook is going to be very different in an environment where inflation is accelerating back towards 4% compared to one where we're coming nicely lower from 9 to 6 to 3, as we have done over the last 12 months or so. And I think when you look at what the market's pricing in terms of Fed policy, we've still got just a 1 in 5 chance of another hike before the year is out. Yes, the dollar's rallied a bit. Yes, Treasury sold off a touch last week. But I think, again, we could be in a situation where the market's getting a little bit ahead of itself, not just in terms of the lack of hikes priced for this year, but also in terms of the 2 cuts that it's got priced in for the first half of next year. Inflation hasn't gone away. The problem is seemingly not getting much better at the moment, given the headline inflation rate that we saw last week. And I just wonder, Ryan, whether we get a couple more prints in that direction, whether we go to 3.3, 3.4, keep ticking higher over the third quarter, we could be in a very, very different place when it comes to the policy discussion, particularly when it gets to the November Fed meeting.
Yeah, very much so. I mean, I think there was a bit of relief that it wasn't as high as the 3.3 that a lot of people were expecting. But like we said last week as well, one swallow doesn't make a summer, as we're using that analogy at the moment with the weather. But if we get another print next month and it's higher still, then that's going to bring the stickiness back into the inflation picture. All those cuts are then going to look a bit silly, and we've had banks, forecasting when the Fed's going to cut all the way through this. They're going to get revised again. So yeah, it's not like looking at a chart, a normal price chart. Inflation's dropped for the last year, and it's been lower. At some point, that's got to stop. Now, whether it stops and it's just a dead cat bounce, maybe this month is, or whether it's now going to start creeping higher, that's the big risk for the central banks, not just for the Fed, but for all of them. Because if they start seeing inflation entrenching again and moving back high over a prolonged period, then they're going to have to talk hawkish again. And, rates are already at pretty dangerous levels, if you think. 5.5% for the Fed, for the BOE is going to be getting there, the ECB going to be lagging, but they're still at high levels for them. And if they have to start talking more hawkish again, I think the market's going to get a little bit worried because, where will rates have to go in that situation?
Yeah, absolutely. And I think it's going to be a kind of case of once bitten, twice shy in terms of central banks. They've been caught out by inflation once. They're probably, and this is something we've spoken about at length, they're probably going to err on the side of doing too much in the future rather than doing too little in order to avoid making the same mistake again. And just to your point around a kind of reacceleration, I've got to give credit to Dick Matthews for this, who I'm sure will have a comment about my sartorial inelegance at some point during the week. If you look back at the last two bouts of serious inflation that we had, the first was in the 40s and 50s after the war, just as Dick started his career in the city, and it was three peaks in terms of CPI. You then look at the 70s and 80s, and again, it was three peaks. We had a peak, we came lower, then we resurged, came lower, and we repeated it a third time. And you then just start to wonder, are we going to see history kind of rhyme with this bout of inflation that we're seeing? I think it's certainly something that you'd be very remiss to just fully buy into this immaculate disinflation narrative and expect the Fed to cut 4 or 5 times next year as markets are pricing. I think there's certainly a risk that we do see prices tick higher in quite a significant way again.
Yeah, absolutely. And I think what we've got to look at is that a lot of the market is aware that these hikes are potentially going to cause damage to economies. Okay, we're not yet seeing that too much in the US. Look at Europe. Germany's in a bit of a mess. China's in a bit of a mess. The UK, well, we've got this mortgage bombshell to come with all those refinancing deals going ahead. So if they have to hike again and push rates up even further, that's going to potentially cause a bigger crash to the economy than what they'll get now on these soft landings. And so what we know with cycles these days is that they're much narrower. We always know that cycles are much faster now. It took 2 weeks to get over the COVID blip where markets crashed, so these things happen on a faster scale now. So, but if we do get rates going up to 6% in a lot of the central banks, I think the effect is going to come pretty soon after in terms of negative impact for the economy. And then we're going to speed up when rates will get cut.
Yeah, absolutely. Well, stagflation, there are no easy answers or easy solutions in terms of getting out of it, as the UK, Europe and all the rest of it are now sadly finding out. Speaking of the UK, mate, we've got, you have, I'm going to be on the beach somewhere, a busy economic calendar in Blighty this week.
Yeah, definitely. And there's going to be some big news for the pound this week. The data calendar hots up this week, a little bit quiet last week. Obviously, we had some CPI numbers and some data, but usually the week after the NFP, it's fairly quiet. So today we've had the UK jobs and US retails. We get the first US manufacturing numbers from the Empire, and then we get Canadian CPI. Friday, we get Japanese CPI, which is going to be big for the yen. On Friday, we get UK retail sales. But the big number for me this week is going to be the CPI data on Wednesday. I think, talking about inflation, is going to be a real decider for the BOE trade. Now, CPI is expected to drop a good chunk to 6.8% from 7.9%. The core, not so much, coming down to 6.8% versus 6.9% previously. So it looks like the market's probably been watching some of these shows and these trade-off shows, because we've been saying for a while we expect CPI to start coming down, really significantly from about now. But for trading the pound over this data, I would have liked to have seen expectations a bit closer to last month's rather than this 1.1 percentage point drop that they're expecting, because that leaves a lot of room for an upside beat of those expectations. But however, if the numbers are confirmed, the market could add to the BOE reprice further, in terms of hikes, meaning the pound find itself under pressure again. Right now, there's a 71% probability of a 25 pip hike at the set meeting. That might get kicked further down the road if the inflation data is soft. But again, if it's on the high side, then we're going to keep those rate hikes entrenched for September.
Yeah, absolutely. There's actually something I disagree with you on there. I don't think the inflation data is the big one for the UK, for sterling, or for the BOE this week. I think it's the jobs data instead. I think if you look at the drivers of inflation, particularly the headline number, everyone knows we're going to see a big fall, whether it's 1.1, 1.5 percentage points, whatever. We're going to see a big fall because July was when the latest energy price cap and energy price guarantee stuff was revised lower. And that's just going to mechanically drag the headline rate down. So core inflation obviously needs to be watched. And as you rightly said, that is remaining sticky. But I think the BOE's big concern at this point is the labour market, and particularly earnings growth. Regular pay grew in the month of May because, of course, it's 2 months delayed. Grew at a record pace outside of the pandemic. And if we continue to see this pace of earnings growth, and just speaking anecdotally from a lot of the strike action and industrial settlements and union agreements that have been struck, you're seeing, double-digit pay rises are becoming relatively common. In terms of some of these big disputes, and they're affecting tens of thousands of workers, which is obviously going to put upward pressure on those metrics. And I think the BOE were quite clear, particularly Andrew Bailey at his press conference, that one of the big things determining their reaction function now is going to be earnings. If we continue to see what would then become real wage growth, if you have inflation coming down to below 7% and earnings increasing, 7.2, 7.3, you're starting to get real wage growth within the economy. I think that is more likely to push the BOE towards a hike in September. But I do think if we do see inflation continues to come lower, I think the BOE's bias, as it has been for quite some time now, will be to end the hiking cycle as soon as they can possibly get away with it.
Well, I might disagree with your disagreement there, because these strikes, we've been talking about them for a long time now, and they're due to kick in. Obviously, we've got the NHS pay resolution 6% that's going to be coming into the public sector, and I think that's where you've got to watch the numbers between the public sector pay and the private sector pay, because you need to define who's driving the bus. If we see a strong
no one, they're on strike.
Well, no, they just had a pay rise, double digits, according to you. But if we see the public sector wages increasing, that's driving any big number we see there. That's only going to be taken as a one-off. It's not going to be something that's going to last for months and months and months. It's going to show those pay increases going in, and that's all settled, and we can move on. The private sector always runs ahead of the public sector, so that's what I'm saying is you need to watch between the two of them. If we get a moderate bit upside move in private sector, but it's public sector driving the bus, then that's something that the market might brush over because it's going to be a one-off thing. But then that's going to feed through to inflation later on down the line, which again, why we might see sticky numbers. And if it doesn't drop as much as expected, then again, that's going to keep the pressure on the Bank of England as well. So there's going to be something for everyone, which is why I say it's the most important data.
Well, there we go. Let's have a chat on Thursday and see which turns out to be the most important, shall we? It's interesting, though, actually, just anecdotally, again, speaking of earnings growth, obviously in the US at the moment, it's been 12 months or so since I was last over here. Just some of the sort of help wanted signs that you see. The earnings seem to have gone absolutely berserk over here. You've got McDonald's now paying people $21 an hour here in New England. UPS drivers, it was saying on the television last night, are now earning up to 170 grand a year. So I might actually stay and start delivering parcels, to be honest.
Or flipping burgers, one or the other.
Well, or both. Why not?
I can just see you in a little McDonald's hat and a little apron, yeah, and with 2 stars, Michael.
Well, at least I'd be winning an award. I'd be doing something right. Right. In any case, speaking of summer holidays, let's get on to the next topic, because although it is summer, you do tend to see trading volumes decline, liquidity thin out a little bit, and the markets perhaps become a little bit boring, as we were talking about earlier. You know, there wasn't that much meat on the bones in terms of what was going on last week. I think there were also a couple of good examples and lessons in there of actually why it pays to remain alert, and perhaps even more alert than usual at this time of year if you are trading the financial markets, because there were a couple of examples, as I said, of significant, unexpected and moves across a range of asset classes that also then faded very quickly. And nat gas is probably the best example of that. You had nat gas futures in Europe last Wednesday rallying about 30-odd%. Futures in the US rallied about 10%. And this was all on concerns over winter supply, that there were not going to be enough LNG. There was a strike going on in Australia that potentially threatened supply. And all of a sudden, in a thin market, that news drops and the price goes absolutely crazy and goes through the roof. And I think this just speaks to, again, the need to, if you are trading at this time of year, risk management is absolutely key. Position sizing is absolutely key, because if you were short nat gas into that move, all of a sudden you are 10% underwater in the blink of an eye, and you need to be managing those trades appropriately in order to ensure that you don't get your fingers burnt by that. And obviously, nat gas is an incredibly volatile instrument at the best of times. It's probably worse than usual in the middle of summer when nobody is at their desks, particularly as it's a market that is sort of made in the old-fashioned way, if you like, with people actually sitting there trading. But you've also got other things going on. You know, there's still shenanigans going on in China. There's worries now around deflation in China, which, when we're all talking about inflation, China is again on the other side of that story, talking about deflation and how deep into a deflationary spiral they may slip. The market is continuing to be disappointed on stimulus hopes. We've got retail sales and industrial production out of China this week. And again, I think it just speaks to the need to be really alert to what's going on, really attuned to what's going on. And actually, if you are taking a break at this time of year, as I am, there's nothing wrong with having a flat book. In fact, having a flat book is probably the best thing that you can do if you are taking time away from the desk, because you're going to protect yourself against those unexpected moves. And as we always say every week, the trades will be there, and new trades and new positions, opportunities will open up and present themselves upon your return. So because it's summer, you know, don't try and be a hero, be sensible. Risks are out there, and things, this kind of silly season will come to an end. And when it does, make sure you've still got your account and you are ready to take advantage of what may come at that point in time.
Yeah, absolutely. And I think, I was looking at volatility last week, and it hasn't really come down as much as I thought it might this week because we've got all these events going on. But just taking it on a slightly different tangent to what you're saying, I think looking at commodities is something we perhaps are not paying enough attention to at the moment. You know, you mentioned LNG. We've had the problems with wheat prices, you know, after the Russian stoppage of the grain deal. We've had India now stopping rice exports. That's another commodity that's shot up in price. So I think, we need to pay attention to these commodity moves, because they are spiking, but it's going to do two things. It's going to impact markets going forward. It's going to impact inflation going forward. You know, food prices are a big driver of inflation at the moment. Yeah. We're starting to see a pickup there and prices rising, and now it's across a broad range of commodities. Then the central banks are going to be in trouble again. And, you know, you can't really fight imported inflation like that, particularly a country like the UK, who imports a lot of energy. You know, when prices rise, rate hikes don't do anything for that. So it's one of those things where they have to sit back and wear it. So I think it's important to keep an eye on these commodities, because when you get one thing moving, okay, but when you get two or three things moving, that's building a bit of a trend you need to watch out for.
Yeah, that's very, very true. We do seem to be at the beginnings of what could be a sort of commodities bull market. And as you say, places like the UK are very, very exposed to that. I mean, I can't imagine we're going to turn the countryside into a rice paddy overnight and, you know, make up for
the way the weather's been, it'd probably work.
Well, actually, that's a very good point. But also, not only the inflationary side of the argument, but also you've got the growth side of the issue, whereby, if you do see a sustained rise in nat gas prices, a sustained rise in crude prices, that is going to have an impact on the growth side of things, because it is going to mean that production may have to be lowered, and all of the discussion that we had pretty much this time last year, we might end up having to have the same conversation again, but in an economy that this time is dealing, in the UK's case, with 8% inflation rather than one that was dealing with perhaps lower price increases in the past. So all fun and games there, as always.
Yeah, it's always fun and games here. As you well know, that's probably why you've buggered off for 2 weeks.
Well, I have, but and I was hoping to avoid this topic, but you've brought it up anyway. We're going to have to talk about it. I knew you were going to moan about this one, but I've got plenty to moan about today.
Well, you're in the right place, so you should be doing some research over there on this topic. But the US elections, this is something that's caught my eye over the weekend, and it is too early to be talking about it in earnest. But as I'm someone who likes to trade on a long horizon, being forewarned is being forearmed, and I'm really picking this up from a story about Trump over the weekend, who completely upstaged his closest rival DeSantis at a Republican rally. This is despite being indicted 3 times and a 4th potentially on the way. He's still streets ahead in the race, according to Republican polls. Those polls are putting 34 points ahead of DeSantis. So, he's really running ahead here. And with next year being an election year, we're going to see more and more news coming out about the race, and we will need to watch for any market signals about what they think about the overall election. Biden may have taken the title away from Trump, but he's looking far too old and frail to continue for another 4 years. But his main winning campaign points at the moment may be that inflation is coming back down and the economy is making a soft landing. From an election point of view, it's the perfect scenario. And that'll be very hard for Trump to fight against if he makes it through as the nomination. But the election is a long way away, and anything can happen in between. But if the US is faltering and Trump is in the running again, will the market accept Trump round 2?
Oh, God only knows. It is becoming a thing over here, actually. What is it? August 2023. So we're 7 months out, I think, from the first primaries and caucuses. And obviously New Hampshire, which is just next door to where I am, is one of the first states to hold their primaries. So there is a lot of, not necessarily campaigning going on, but you do see a lot of stickers and placards on both sides, and a lot of Trump. I was going to say memorabilia, paraphernalia. That's the right word, on bumper stickers and in shops and things like that. So it is starting to become an increasing topic of conversation over here in the US. And as you say, although it's not necessarily a theme that you can trade in the here and now, it is something that we need to put on our radars, because it's going to sneak up on us very, very quickly. And by the time we get to those first primaries in February, March next year, it is going to be, is it Trump? Is it DeSantis? Is it someone else on the GOP side coming out of the blue entirely? And then you've got to think, who's the front runner? How does that fare up against Biden? Does the market prefer the status quo? Does the market prefer what could be considered more pro-business if we're going to get more tax cuts and all the rest of it? But do we then have another trade war with China and potential geopolitical instability as well? So I think for me at the moment, the election is a lot more kind of questions than answers, but those questions are going to be answered very, very quickly. And as we all know, narratives in markets can change very, very rapidly indeed. And I think that's going to be the case with the elections. It's going to be 3 months from now, 6 months from now, all we're going to be talking about. And it will be all we're talking about for about a year.
Yeah,
and
exactly. well, maybe I'll do you a favour. Next week, we'll talk about the UK election, which is also coming next year.
Oh, God help us. I saw actually, I think it was one of the last things I read before I left the office, that Rishi was apparently thinking of holding the election in November 24. So we might have a US election and then a general election in the UK within about a fortnight of each other. So, yeah, that'll be good for the old stress levels and the hair loss, won't it?
Yeah, I think I might book a couple of weeks off then.
Yeah.
Where should we go?
I don't think I'd be allowed. I think I'd be shot if I tried.
Yeah, where should we go? Australia? We go to Westy down there for a bit.
Take some shelter down there. Right. Well, speaking of Australia, I want to talk about the Aussie dollar, actually, in the first part of That's a Setup. Right, so revisiting last week's play of the day here, actually, as those who will have watched last week's show will know, I was short the Aussie dollar last week into the 65 figure and also into the 64.60 level. Well, we got halfway there. We had a nice closing break below the 65 figure on Friday, but we haven't quite got all the way back to the May lows just yet. I think things still do look pretty poor for the Aussie dollar. I mean, the bearish factors that I outlined last week haven't really changed. You've still got a little bit of risk aversion across the board when you look at equities in particular. Seasonality is still poor from here to mid-October, as we mentioned, and you've still got these worries going on about the situation in China. But I think compared to where we were last week, given the move lower that we've seen, a big figure or so, the risk reward now in being short, particularly while we're above this 64.60 level, perhaps isn't quite as good as it was looking this time last week. So the key question I have is, what happens when we get to the May lows at 64.5? Do we break it? Do we break it on a closing basis? More importantly, if we do, you then start to look at where we were in the fourth quarter of last year, which is kind of the high 62s, low 63s, where there's a bit of congestion that may provide some support. Or do we hold the 64.50 level on a closing basis, in which case we go back into the range that we've traded for much of the year? And as I said, given that where we are, the risk reward doesn't look to favour shorts in my view. And given the general theme of G10FX this year, which has been get to the bottom of a range, break it, and then it turns out to be a failed break, I'm inclined towards the latter of those two scenarios that I laid out for the moment.
Yeah, very much so. I mean, that low was a bit of a spike, that 64.60. So I think you've really got to look at this 65 handle. And if we start to hold under that, then you're probably going to see further downside. And I'm not sure that 64.60, 50 area will hold up. But, we have to trade what's in front of us. If you're short from above, then you've got some mileage in the position, you've got some margin in the position. So you can do one or two things. You can get out all the position and maybe reload in another bounce, or you can take partial profits, lock in your stock behind so you protect what you've taken off the table already, and then see what happens at the level. And if the level doesn't break, well, then you're protected and you can decide what to do from there. If it does break, well, there you go. You look for the confirmation, hold. You can get back into trades, add back in what you cut already, move your stops again to adjust your position further into profit or less of a loss. And then you look to ride the wave again lower. So there's two ways of trading these sort of things. But I don't like to give up a winning trade, never like to give up a winning trade. So my best way to do this would be to take some off if we get down to that 64, 60, 50, bring my stop down behind it, see what the level wants to do after that.
Exactly. Manage that risk as much as you can. Right. Ryan, I'm sure you've done this just to try and wind me up while I've been away, bringing out all the greatest hits or the worst hits this week, aren't you?
So, yeah. We had that first move up to the 728, and we've had a bit of a pullback for about a month or so. Hasn't gone too far, down to the 710, 712 area. A lot of that has been, or this bounce from that area has been driven by the data. We had the trade data early last week, which was, although the trade balance was a 10 billion plus surplus on top of the month previously, the activity numbers, i.e. what caused that surplus, was pretty atrocious. Double-digit drops were imports and exports. So on the activity side, that was very negative. So that saw us moving up in $1. Then we got the CPI numbers going negative, as you mentioned. But this time, officials were ready for the bad news because they sent out the state banks to sell dollars into the market again. And then National Bureau of Statistics came out saying, "Oh, it's no problem. It's a one-off number. We won't be down here for too long." But that hasn't stopped the market from running this one higher. So we had the hold of that 710, 712 area. We've bounced back up today. We've gone above 728 as I'm speaking here. This was the sort of area where I was last trading it. I was last in longs. I expected the PBOC and officials to come out with stronger language and rhetoric about the weakness, which they did. But this time, I think they may be a bit inclined to let this one continue further, given that the weaker currency could help with their exports and indeed their investment flows. So trading wise, I'm watching closely these 728 highs, as if we get a confirmation break of this, we might be going up to the 2022 highs around that 737s area. On the dips, if we get an 720.21 is the area I might look to grab some dip longs.
Yeah, it's certainly an interesting one. And actually, as you said, although we did see a little bit of pushback last week, it doesn't seem to have been perhaps as strong as you might have expected. I guess the other point I'd make, just in terms of the Chinese data, and I mentioned earlier, we've got the industrial production and retail sales figures due a little bit later on this week. We all know that Chinese data is made up. Let's not beat around the bush. You can't, it is not reliable in any way, shape or form. You've got to take that into account, because the data last week was absolutely terrible, but it's made up. So how bad is it in reality when you actually get to the real number rather than the fake number that's being published? So I certainly think that short CNY is looking like an attractive view at the moment. But of course, you do have that risk in there, as you've got a little bit with short yen as well, of the authorities just coming out and smacking it down at some point. But given that they've been relatively timid so far, I would be tagging along with your view.
Yeah, I mean, they can't get away so much with the data these days, because the market will know, and there's enough sources coming out of China that could tell you whether they are messing with the numbers. So I don't think it's quite as made up as it used to be in the old days when they could get away with it. I mean, those trade data numbers last week were atrocious. There's no hiding behind that. If they suddenly turn around and everything's up 20% next month, then yeah, you've got a fair point. But we can only
shall we revisit that in a month?
Yeah, we can only trade what they tell us, and the market's going to react to that. But as you say, they did come out for the last month, and they have been sort of smoothing things in the currency, but they haven't been as strong with it this time around. So I think there's every chance we might be visiting those 737 highs.
Yeah, indeed. It just kind of implies a little bit of a level of contentness with that. Otherwise, you would expect them to come out a little bit more aggressively. Anyway, let's move over to the motherland, the United Kingdom. Don't look at the FTSE too often, but I think it's worth a bit of a gander nonetheless. I mean, we had a big fall in the FTSE 100 on Friday, and actually it was a fall that we saw across the European equity complex. Most bourses were down between 1 and 1.5%. But the interesting thing about the move lower that we saw in the FTSE was we rejected the 100 and the 200-day moving averages pretty rapidly, as you can see how quickly we turned away from the green and yellow lines on the chart there. And into the close on Friday, we actually fell below the 50-day moving average as well, which comes in at around 75.40. So I think this is now a very, very interesting spot for the main UK benchmark. And I use that term loosely because, as we all know, the FTSE is heavily concentrated in overseas firms rather than those which have a huge domestic operation in the UK. But on a technical level, at least, you've got this trend line coming in around 75.25. Break below that, and there's not really too much below it. You've got a level in there at 74.50, which is a low that we tested a few times over the last couple of months. And then really look out below, I think, is the message that the chart is sending. But although the technicals do look rather sickly and rather poorly, as most will know, I'm not particularly bearish on equities over the medium term or the longer run. I find that view very, very hard to get on board with. And I think it's worth noting that actually, if we were to see more of a risk-off move in terms of a global sense, then actually that could be a little bit of a saving grace for the FTSE, because it has a very, very close inverse relationship with the pound. And if you were to see a big bout of risk aversion, then you'd likely see sterling come lower. And in any case, I see very, very little case for sterling upside from here. So actually, if you compare the FTSE to its DM peers, although we may see a bit of a move lower, if we do see a bit of a sell-off, I think that sell-off could be a little bit more limited in the UK index than we may see elsewhere in the developed market.
Well, another thing you've got to look at is once again, the UK seems to be confounding the bearishness among us, or the bears among us. I'm looking at you, Michael, because we got that GDP number. Yeah, we got that GDP number, which was better than expected. So, that gave a little bit of boost. But for the FTSE, technically, it's looking very strong. You've got that big level at 77 now. It's confirmed the break several times after coming down from the 78, 79s. Now you've got the break of that confluence, the moving averages, which, if you didn't catch the break the first time, you had the confirmation. That's what you want to look for in a broken level. And further downside has happened after that. So you know where your levels are. So it doesn't matter your bias on the UK, it doesn't matter your bias on the FTSE. Technically, you know exactly where to sell against, where to potentially buy against, where you're right and where you're wrong. And that's all you need for trading. Absolutely.
Right. I've got a bone to pick with you now, mate. I'm not allowed to ever mention this, and then you throw it into the show. How does that one work?
See, that's two things I knew you'd moan about today. Because so I'm going to have a go this time. The S&P. You've pretty much milked it for the last 6 months. So I don't mind if I talk about it. Once in a blue moon.
But, go on. I'm feeling kind.
Okay, all right. But this one, potentially down but not out. My main reason for wanting to talk about this because I'm in a position, so I'm keeping a close eye on it. I'm short. I'm looking for a further breakdown. But as with all my trades, I have to be objective about an asset, irrespective of my own positioning. So I'm short from high up in the 45.60s. I've been waiting for a break pretty much all last week of the 44.80 area. It's taken a while, but that might be starting to confirm as we're now trying to hold under 44.80. We found support around the 45.50 area, which now means we have to make another break to see further downside. And if the fight is as hard as it was at the 44.80 level, this could be a long wait. Now, this support area could be a bit of a make or break for the move, all the way down from 4,600, as it was a strong resistance point on the way up there. So if we are to see a bounce, this is where it needs to do it. Fail, and we could be down to the 44 even area pretty quickly, I think.
You know what I'm going to say, don't you?
Go on, let's hear it.
Well, buy the dip.
Buy the dip. Where are you going to buy the dip? You're going to buy the dip 44, 45 and a half?
If we get down to 44, then I would be scooping up everything you can get. There is value in, and that can be extracted by playing equities from the short side over the very, very short term, as you have done so well there. But you've got, and I was actually talking with a client about this a short while ago. Fundamentally, with the equity market, you're dealing with something that goes up and to the right, and that is just the bias. And personally, I don't have much desire to be fighting that bias. So if we do see, another 5% or so in terms of downside, then great, smile on my face, and in we go with the buy orders.
Right. Well, let me put you on the spot then. Let's have another little friendly bet, a couple of pints on this one. I'll even give you a 10 pip head start. I've just checked it. We're trading 44.60s at the moment. So, what's the next big figure to trade? 46 or 44?
The next big figure to trade.
Yeah.
And we're trading 44.60.
Yeah, go on. You can have a head start. 44s or 46?
46.
46. Okay, right. I'll take the other side.
I knew you would.
So give me a big head start, that one.
Well, there you go. People have had a bonus play of the day. Let's get on to the proper two anyway. Of course, I'm long risk, always long risk. Actually, you're getting 4 plays of the day today, because my real play of the day is to do absolutely nothing. I've got another week left on holiday, away from the screens, away from the terminal. So in the real world, I certainly wouldn't be taking any positions in that environment. But for the purpose of this show, I must submit one, or as it's turned out to be 2, in any case. So short euro dollar is starting to look a little bit more attractive for me. As most will know, I don't really think that the euro has particularly much going for it. Economic data continuing to soften, as we alluded to earlier, as the economy loses momentum, not just in Germany, but more broadly across the bloc. You've still got core inflation remaining pretty sticky around this 5.5% mark, and the ECB were very, very dovish in July and don't appear to want to hike in September if they don't have to, which implies that you could get sort of stagflation setting in across the bloc. So you've got that divergence, you've got a relatively weak economy, you've also got the fact that we've spent a while now, a couple of weeks, consolidating below 110. We've had a few spikes above that level, as you can see on the chart, but we haven't managed to make a proper break above it on a closing basis. And I think with the market still pricing about 20 basis points worth of tightening from the ECB before the end of the year, that's probably going to end up being priced out at some point soon. So I like leaning against this 110 handle from the short side. If we were to get a closing break below the 100-day moving average, which comes in around 109.30, then I'd be looking to add to that position. Initially looking for the low 108s, with, of course, the 200-day moving average coming in around 107.75. But again, if we do get a closing break north of the recent highs, which are around 110.25, then I'd be wrong and looking to get out. But that is my synthetic play of the day this week. Ryan, what are you looking at, mate?
Yeah, well, I'm going back to dollar CAD. This was my play of the day last week, and I hope people called it in time because we got the break up from 134s all the way up to 135s. So that worked nicely for myself. I got long and I knocked out pieces all the way up to the 134.90s. I folded the rest. Well, actually, I went on small short up the top there as well, just for a separate trade, and managed to pinch and pips. But I've got a call long going that I started 131.50, so I'm going to be folding bits and pieces back into that core position, just building up a further position here. But this trade now is about playing pretty similar to last week, but instead of playing what happens 134, 135. Well, sorry, we're going to play 134, 135 again. This time it's more of whether 134 holds as support. We had a little break under last week, but it's back above now. Might be holding again. So that's going to be my area to look to add back into the position if we get a test and hold of 134. Conversely, on the other side, going to play the 135 level like I did with the 134 level last week, which is potentially looking for a break. Buy stops just through the level, see if I can add back into the position and get a runner there. If we do get that break, we could be 136, 137 bound potentially on this one. So I'll look to add to my longs. I think the trade really becomes invalidated if we're back below sort of 133.70 with a sort of final line 133.50. That would completely invalidate the trade. So looking a bit of a rinse and repeat from last week.
Good stuff. Levels on both sides of the market and two different ways to play it. Brilliant stuff. Well, that brings us to the end of another show as the trade-off goes global. Thank you very much, as always, for Ryan Littlestone from Forex Flow Live and Forex Analytics for joining us. And thank you also to Kyriakos, who is, 7 hours different from where I am, but has still managed to bring this show together as brilliantly as he always does, if I can get my words out. All three of us will be back this time next week. If you enjoyed the show, drop a like on the video, leave a comment as well. Let us know how you're trading the market. So if there's anything you'd like us to discuss, or if anyone knows any good restaurants in Boston, then send them my way as well. And we will be back with another episode of The Trade-Off this time next week. Thanks as always, and goodbye for now.